Hey guys, welcome to episode 2 of the Young Investor's Handbook. Thanks for checking out my video again, and if you saw my last video, we talked a lot about compound interest in time and how those two things are the biggest asset for young adults whenever they start investing in the market. I can't overemphasize how important it is to begin investing early in your adult life, because that's when you have the most time to allow that compound interest to continue making more and more and more money on your investment to where you've generated an overabundance of wealth by the time you retire later in life. And as we saw with the example of Jack and Jill, it really doesn't take a lot of money up front if you begin investing early in your life. However, the longer you wait, the more money it takes to allow that compound interest to start working for you. And while it's absolutely essential to begin investing early on, we don't want to get ahead of ourselves and end up making mistakes that cost us thousands of dollars later on in our lives. And that's the purpose of this video, is to make sure your investments are contained within the correct vehicle, to make sure you're getting all the tax advantages you can, and also make sure that Uncle Sam doesn't try to dip his hand in your pocket when you go to access those funds. And one of the best ways, if not the best way, to make sure you get to enjoy all the wealth that your investments generate is to make sure you're using an IRA. And for the purposes of this video, we're going to assume that we're all working a normal job and making less than $100,000 a year. The rules change a little bit for those of you that are self-employed or making over about $120,000 a year. So in order to keep it consistent, again, we're going to assume that we're working a normal job making less than $100,000 a year. So to get started, a very obvious first question you may have is, well, what does IRA even stand for? And it's simply an individual retirement account. So by the name alone, you know that the purpose of this account is to generate wealth for your retirement years. The purpose of this account isn't to throw money into and trade stocks with for a couple of years and then pull all your money out and go buy a new car or something. The purpose of this is to generate wealth in the long term for your retirement. And unlike a traditional investment account where you have to pay huge capital gains taxes on whatever money you generate within that account, this helps avoid those taxes and allows you greater access to your money later on to where you don't have to pay those taxes or you get a deductible up front. So depending on your particular goals and situation, you'll either want to open up a traditional IRA or a Roth IRA. I'm going to talk about a traditional IRA first and also explain some of the key differences between a traditional IRA and a Roth IRA, and then that should help you decide, based on your goals, what the better account would be for you. To start, you can contribute up to $6,000 per year into a traditional IRA. Now that doesn't mean you have to contribute $6,000 per year, but that's the limit. You can't contribute any more than $6,000 per year into a traditional IRA. And if you saw my last video, even if you don't have $6,000 to cap out that IRA each year, even if you invest a moderate amount or even a little bit each year, using compound interest and allowing that to grow over time can still have huge effects on your retirement later on in life. But it should be everyone's goal to try and hit as close to that $6,000 limit as they possibly can, because that's the way you can get the greatest benefit out of this IRA. And the factor that makes the traditional IRA so valuable and causes it to blow an individual investment account out of the water is the fact that that contribution that you make to your IRA each year is tax deductible. And trust me, that was a lesson that I had to learn the hard way whenever I was investing early on. I was so jazzed up to just open up my first regular individual investment account, start trading stocks, and feel like a real Wall Street executive that I gave no consideration to taxes. So the following year when tax season rolled around and I saw what I was paying in short-term capital gains, which was well over 20%, that it was an absolute shock to my system and a mistake that I promised that I would never make again. So since the traditional IRA gives you such a big benefit of those contributions being tax deductible, there are some basic rules that you have to follow when trying to access your money. Since the purpose of this account is to generate wealth for your retirement years, if you have to access funds within that account and withdraw them, whatever funds that you take out is subject to a 10% early withdrawal penalty and also normal income taxes. That's why it's so important that you don't consider this account to be a savings account, so to speak, that you can dip into anytime an emergency comes up or if you just want to make a purchase. But this is truly investing in your future. And the main goal is to just not touch it until you reach that 59.5 age limit. So once you reach the age limit, you can start taking normal distributions of that money without the fear of paying a 10% early withdrawal penalty. Now remember, since those contributions going into the traditional IRA were tax deductible, when you start taking money out of the traditional IRA, then you have to pay normal income taxes on that money. And there's also a unique rule to the traditional IRA that once you reach 70.5 years old, you must start taking distributions from your IRA account. You can't just leave it in there forever and never access your money, which I don't know why anyone would want to do that anyway. So now that we have a basic understanding of a traditional IRA, I want to talk about the Roth IRA. Now, just like the traditional IRA, within the Roth IRA, you can contribute up to $6,000 per calendar year within that account. But here's the key difference. With the Roth IRA, the contributions are not tax deductible. Now, I know what you may be thinking. That kind of stinks, and why would anyone ever choose a Roth IRA over a traditional IRA whenever I could get a tax deduction on those contributions? Well, here's the thing. If you have a Roth IRA, whenever you turn 59.5 years old and are able to access those funds, you get that money tax-free. So that's the major trade-off between a traditional IRA and a Roth IRA. Within the traditional IRA, you're getting a tax deduction up front, but then have to pay taxes later on whenever you access that money. With a Roth IRA, you get no tax deduction, but you also don't have to pay taxes whenever you access that money later on in life. Here's a couple of cool things that I really like about a Roth IRA as opposed to a traditional IRA. If you ever find yourself in a situation where you need to access money within your Roth IRA, you can withdraw any contribution that you've made up to that point without incurring that 10% early withdrawal penalty. So here's an easy example of what I mean by that. Let's say I've contributed $40,000 into a Roth IRA over my lifetime, and that Roth IRA has grown to a value of about $60,000, again, due to time and compound interest. If I find myself in a situation where I need to access money from my Roth IRA, I can withdraw up to $40,000 that I contributed without paying that early withdrawal fee. However, if I access any amount above what I've contributed, then that's subject to taxes and fees. And another cool feature about the Roth IRA is that even whenever you turn 70.5 years old, you don't have to take normal distributions like you do on a traditional IRA. You can keep letting it build up and generate more wealth for you if you don't feel like you need to withdraw it at that point in time. So all in all, it basically just gives you more freedom to access your money as opposed to a regular IRA. So now that we know about the traditional IRA and also the Roth IRA, what are some situations that you would choose one over the other? Remember, the biggest benefit to a traditional IRA is the fact that you get a tax deduction on whatever you contribute into that account. So if the tax deduction allows you to contribute more within a traditional IRA than what you could into a Roth IRA, then the traditional IRA is certainly the way to go. Another advantage is if you're someone that is currently in a higher tax bracket than you feel you will be whenever you're retiring later on in life, the traditional IRA is a better choice for you. Because again, you're deferring taxes now whenever you're in potentially a higher tax bracket, and then paying taxes later on whenever you're in a lower tax bracket. Now on the other hand, a Roth IRA has big advantages too. If you're like me and expect to be someone in a higher tax bracket whenever you retire, as opposed to right now, it's more advantageous to just go ahead and pay those taxes now. That way you can access that money later on in life, tax-free, free and clear, and just have that money. The other advantage to a Roth IRA is it gives us so much more certainty whenever we go to access those funds later in life. Because 20, 30 years from now, we really don't know what the tax situation is going to look like or what tax rates within certain tax brackets will look like. So for me personally, I like to have the freedom of knowing that regardless of what the future looks like, I don't have to pay taxes on that money. Another advantage is if, God forbid, we find ourselves in an emergency and we have to access funds within an IRA, if it's a Roth IRA, we can withdraw any of that money that we've contributed up to that point without incurring the 10% early withdrawal fee that we would incur on a traditional IRA. So the lesson here is, even though there are some trade-offs between a traditional IRA and a Roth IRA, you really can't go wrong with either. Both definitely have huge advantages to them and are so valuable when it comes to investing money and generating wealth for your retirement years later on. Because regardless of if you choose a Roth IRA or a traditional IRA, there are tax advantages to both. And just because you choose one now, that doesn't mean you can't choose another one later on. Personally, I have a Roth IRA and a traditional IRA. Now, full disclosure, I contribute most to my Roth IRA because, again, I like the idea of knowing that I get that money tax-free later in life. But if I ever find myself in a situation where a traditional IRA is more advantageous for me in my current situation, then I'll contribute money to a traditional IRA. That's what's great about it, is that you don't have to just pick one or the other exclusively. Now, you can't contribute $6,000 to each simultaneously. You have a $6,000 limit total, but you can certainly split it up between the two or do whatever combination that you would like in order to get the most benefit out of both. I truly can't emphasize how important an IRA is, especially if you're a young adult and beginning investing. It doesn't matter if you have $6,000 or $1,000 or even $100 to contribute each year within one of the accounts. All that matters is that you're putting money in it, investing it, and allowing that to grow over time. Unfortunately, it's surprising and disappointing to know how many people don't take advantage of IRAs. So be the exception. Go out there, take some initiative on your part, and start getting invested, even if it's just a little bit. This truly is one of the greatest investments you can make in yourself, especially as a young adult. But that's all I have for you tonight, guys. And as always, I truly appreciate it for tuning into my channel. And please smash that like button and subscribe if you like my content. And I promise I've got great videos coming your way soon. Thanks again. Till next time.